Welcome to this explainer. Look, even if you follow the financial markets super closely, trying to pick individual winning stocks can be, well, a massive unnecessary headache, right? So today, we're unpacking a really foundational strategy. We're talking about a totally actionable path to building long-term wealth that literally removes the stress of guessing which stocks are going to be the next big hits. Millions of everyday Americans use this exact strategy to secure their financial futures. And we're going to break the whole thing down step by step. Let's kick things off with a massive what if. What if you could invest in hundreds of America's absolute biggest, most successful companies with just one single click? Imagine not having to agonize over choosing between the heavyweights of the economy, but instead instantly owning a piece of all of them simultaneously. It's a wildly powerful concept, and guess what? It is completely accessible to you right now. Now, what's really interesting here is the sheer scale of these names. We're talking Apple, Microsoft, Nvidia, Amazon, Google. Investors usually feel this immense pressure to pick just one of these tech giants and just hope they made the right choice. But with the financial tool we're exploring today, you actually don't have to guess the winner. You can literally own a fraction of every single company I just mentioned all at once in one incredibly simple transaction. Here is our quick roadmap for today. We'll start with decoding the ETF, then cover why ETFs dominate investing, look at real-world investing with Sarah's story, dive into the power of consistency, and finally, avoiding common beginner mistakes. All right, part one, decoding the ETF. So ETF actually stands for Exchange Traded Fund. Let's strip away the Wall Street jargon. At its core, it's simply a basket filled with many different products, usually stocks or bonds. And that exchange-traded part, that just means you can buy or sell this entire basket on the stock market during regular market hours, exactly like you would with a single stock. It's maximum convenience with minimum hassle. Think of it like a giant shopping cart. Buying a single stock is like walking into a grocery store and putting just one single apple in your cart. If that apple turns out to be rotten, well, your whole trip is ruined. But buying an ETF? That is like grabbing a pre-filled shopping cart that already has an apple, a loaf of bread, some milk, and hundreds of other groceries. Why this matters is that you completely mitigate the risk of that one bad apple ruining your entire portfolio. To put a real number on that shopping cart analogy, let's look at the S&P 500. If you buy an ETF that tracks the S&P 500, you are instantly dropping around 500 of America's largest, most profitable companies straight into your cart. 500. With one single click, your money is spread out across 6,000 different major businesses. It's incredible. Moving right along to part two, why ETFs dominate investing. The reason millions of everyday Americans make this their first choice really comes down to these two twin pillars. Number one is diversification. Because your money is spread out across so many different companies, it naturally balances your risk. If one company in your ETF has a terrible year, the others can step up and help balance out that loss. Number two is very low fees. Unlike actively managed mutual funds where expensive Wall Street managers take a massive cut of your money, ETFs usually only charge a tiny annual fee, which basically means more of your hard-earned money actually stays in your account, compounding and growing over time. Okay, let's look at part three, real-world investing with Sarah's story. Meet Sarah. Sarah is just starting out, and she has exactly $200 to invest today. Now, what's so compelling here is the incredibly low barrier to entry. Just $200 is more than enough to set this powerful financial vehicle in motion. You do not need to be rich to start. So, instead of placing all her bets on one single company, Sarah goes ahead and buys an ETF that tracks the entire U.S. stock market. Instantly, her $200 is spread across literally thousands of American companies. This dramatically stabilizes her investment. Over a 20-year timeline, even if some individual businesses struggle or, go completely bankrupt, her overall investment has the potential to grow smoothly right alongside the broader American economy. Now, ETFs come in tons of different flavors. You can get broad market funds, S&P 500 funds, or ETFs focused entirely on technology, healthcare, energy, international markets, or even bonds. But strategically, a lot of experts recommend beginners start with a broad market fund because it provides immediate, comprehensive exposure. It fundamentally protects your portfolio against sector-specific downturns right out of the gate. Let's transition to part four, the power of consistency. Imagine taking Sarah's strategy, but actually putting it on repeat. Imagine contributing a consistent $100 every single month. You do this regardless of whether the financial news is good or bad, and entirely regardless of whether the market goes up or goes down. You simply set it and automate that $100. When you do that, you're actually utilizing a massive financial secret weapon called dollar cost averaging. By investing consistently over time, you naturally reduce the impact of those crazy short-term market swings. Think about it. When the market is down, your $100 buys more shares, right? When it's up, it buys fewer, but your existing shares are worth more. Why this matters is that it completely removes the emotion and the stress of trying to perfectly time the market. Finally, part 5, avoiding common beginner mistakes. I really want you to anchor on this rule. ETFs are designed for long-term growth, not overnight profits. The absolute most dangerous mistake a beginner can make is buying an ETF today and expecting massive, immediate windfalls. Listen, markets naturally go through ups and downs. If you panic and sell your shares during a market crash just out of fear, you literally do nothing but lock in permanent losses. The real secret to building lasting wealth? It isn't jumping in and out of the market chasing the perfect hot stock. It is this simple formula. Patience plus consistency equals compound growth. The most successful everyday investors stay patient, they continue investing consistently through the ups and the downs, and they let time do all the heavy lifting. So, what does this all mean? Well, we've covered a lot of ground today, stripping away the mystery of Wall Street jargon to show you a diversified, low-fee, and highly accessible path to growing your money. So I want to leave you with a question to really think about. Have you invested in an ETF yet, or are you planning to start? Your journey to true financial freedom could begin with just one simple investment. Thanks so much for joining me on this explainer, and I will see you next time.